G'day guys, Josh here. Welcome to another video about the SVB, I guess. So there's another video if you've watched 20 million videos from different reactors on any channel. But there's been a lot of talk about the, obviously, the Silicon Valley Bank collapsing, and a lot of different people who, either they don't have financial experience or just, on the know-how, means it's the news these days, have given their facts and opinions about it and how it means and how it could be the end of the world. And you can see a lot of, obviously, ulterior motives and obviously interest in a lot of people in this issue as well, mainly being the depositors and obviously the shareholders and obviously the people in power and also anyone who banks with Silicon Valley Bank obviously being interested. But there's been a lot of other vested interests as well. The crypto bros trying to be like, this is going to be the end. It's 2008 all over again. Is this the Lehman Brothers? I mean, this is the second biggest bank that has failed. And well, we should get a quick background on why it failed. But yeah, let's just do a quick background on why it failed. But the funny thing is, with the collapse of Silicon Valley Bank, as given by Wikipedia, it is not really that fancy. It's not a big, property play gone wrong or anything like that. But the greatest irony is it's to do with fixed interests. And you'd be like, oh, wait, fixed interest is meant to be a defensive asset. So for all of you guys who are, know a bit about finances and stuff like that, or people who don't, a fixed interest asset is effectively someone lends you a certain amount of money. Actually, other way around. They lend you lend them a bit of money, and you get a fixed percent interest back on the risk premium or whatever it is. You get a percentage back. Like say, for example, you lend money to your friend, and their friend will pay 2% every quarter. You'll get 2% every quarter of that what you lend to them. So $100, you'll get $2 every quarter. And that's what you call the coupon rate. And why I'm talking about fixed interest is this how this bank collapsed. And generally fixed interest assets are pretty safe compared to, investing into a business and anything like that, or investing into property. It's quite safe because you get that coupon rate, and at the end of the loan, you get your money back. Okay. Now, let's talk about this. Okay. So you can see how I call this a perfect storm, because this is a lot of things lining up. So what occurred is that Silicon Valley Bank, they were looking for higher investment returns. So they went from short-term bonds, which are like 1.5% back at that time in 2021, to longer-term bonds, which means you can get a higher rate from it because, of course, go to long-term, they expect interest rates to go up eventually. And what's happened is that the interest rates went up very, very quickly. And generally with a lot of banks, they have both short-term and long-term bonds to avoid duration risk, which means that you are subject, if you've got a long-term bond and you need short-term liquidity, you might be selling them at a loss depending on if the interest rate goes up or not. So fixed interest is very, very exposed to the interest rate. Okay, so if the interest rate goes up very quickly, in let's say 6 months, those long-term bonds aren't going to be that valuable anymore. And that's exactly what happened here, where the interest rate for the long-term bonds were offering 1.5%, and then the interest rate's back up to 5%. Those government bonds become less. Obviously, in fact, the entire fixed interest market had dropped by 10% in the last year due to these interest rate increases. So basically, you're selling government bonds for effectively 10% less than their par price, which is the amount you get back from when you hold it to expiry, which is $100. So effectively, what happened was that basically, due to the interest rates rising, everyone was wanting money to pay down their loans and stuff like that, because loans get expensive, they need liquidity, and they need to pay down their loans and try to keep the interest costs as low as possible. But as people were doing that, Silicon Valley needs to make sure they have money to give to these people as well, because obviously with the banks, not everything is held in cash in a giant safe. Some of it's in its own investments and stuff like that as well, to make sure that it's earning an income higher than the interest rate that they're giving out. And what occurred is that since Silicon Valley Bank had a lot of long-term investment bonds that were less valued, basically they had to sell those off at a loss, so losing 10% of that value to have liquidity. And this was caused in multiple different ways. First of all was panic. Okay, so this is the first thing about lacking financial education, is panic. And you can see what panic selling does. It's a mental psyche, the market, okay, including the bank as well. If the people didn't panic and let Silicon Valley hold those bonds to maturity and get the $100 back, this most likely wouldn't have happened, okay? But people panicked, and some people saw opportunity as well. So the one of opportunity and panic. So what some people did was that they heard, oh no, they're holding bad government bonds, they might collapse if we do anything, we better take all our money out. And then they tell the next bank, like, oh, we protect my money out, so which is actually making the problem a lot worse, because now Silicon Valley Bank may have to sell those bonds to try to pay what you're trying to withdraw, basically, as well. And this is exactly what happened. Now, the panic occurred. Now, someone may be going, oh, why are you blaming the people and stuff like that as well? You know, it's kind of natural for a bank run to occur. But this is how, like, society can operate, is that, you know, panic, the emotions controlling you may make you lead to bad decisions, basically, as well, on the bank's part. And may, you know, people get greedy, obviously, and they might collapse the bank that they were working with purely because they want to get their money out. Now, on the other hand, is, of course, Silicon Valley Bank's investment policy of having more long-term bonds and short-term bonds backfire spectacularly, given the fact they lost 10%. Now, I've got to say here, I'm tending to side of the bank on this one. I think people panicking and trying to short-term profiteer from this has really caused this nightmare scenario. I mean, there was a few people, according to a Slack group, there was a few group chats that basically said a lot of people had tech chat groups. What they were doing is essentially, funnily enough, were telling everyone to get their money out of SVB and stuff like that, and before it, you know, lost all its money. And now the crazy part is, with some of this as well, it's, you know, this is why contagion is such a big issue as well, lacking financial education. You can see here, it's exactly what I said before. One person tells another, tells another, tells another, tells another, and it causes this just like that, okay? And then you just go irrational and just bam. And then, this is the worst part, okay? This is the worst part of it all, okay? After they did this, okay, there was a bunch of Slack chats, okay, I didn't have it in there, that were basically stating, buy the share and withdraw your money, and then you can profiteer on buying the share when it recovers. And I'm sitting there going, mate, you just organized an entire bank run based on the loss of a company. So your greed has in fact got you to lose money because now it's bankrupt and your shares are worthless. And I'm sitting here being like, guys, you guys caused a bank run. I caused an absolute frenzy. And now the bank is bankrupt. And in that sort of way, this is why financial education is important, because the market only works if there's trust in the market. And it occurs just for the little guy as much as it occurs for the big guys, okay? Is that if you erode that trust by, you know, greed and panic selling and stuff like that, it's going to be very difficult to trust the market in the future. That's why there's so many rules and regulations for it as well. Now, I'm going to say I feel sorry for the depositors and stuff like that as well who didn't get their money out in time. Obviously, this is a bank run in general. It's a new digital bank run where people can do it online in a couple of 48 hours. It's, you know, welcome to the new world, I suppose. But I'm going to say that provides my unique take on it all, basically, as well, is that it seems like, you know, our system, our monetary system and stock system as well, it's not that it seems like, it is ran on human emotions, okay? And you can see here, panic completely took over everyone there. And it just also shows contagion so much as well, where everyone was like going, get your money out of this bank now. And then basically spread out everywhere. You know, mate told, you know, Bob told Joe told Jolene, and suddenly everyone's taking their money out of that bank, and then that bank fails because of it, because of the absolute mass panic that it caused. And some people are just opportunists looking this to potentially short SVB, knowing that information, and trying to get the quick buck and run. Now, is this like 2008? I wouldn't say it's like 2008. They were not lending money. You know, the bonds that they had were government bonds. They weren't lending money to people who, you know, weren't going to pay it back, basically. It is just absolute horrible timing, and it's just caused so much issues at the moment. Now, I'm going to say the reactors have been pretty poor, I'm going to say, on this one as well. You have all these people with vested interests, like you can see here, this crypto bro being like, time to go to fiat, fiat bad, go to crypto. Even though crypto is just as worse with a bank run, like it doesn't have any assets backing it, and you know, have a, you know, good old clickbait headline, the banks are failing, even though it's just one bank. And yeah, there is a possibility of a contagion effect, but at the same time, there's a possibility of these banks, you know, buying up these areas at really cheap prices because they've got cash. There are businesses who still have cash to can acquire these assets and also service these assets as well based on the other income. And I think people should be aware of that as well. And a lot of reactors are either telling the complete wrong information, comparing it to Lehman Brothers, which is absolute yikes, and also trying to promote crypto and other things as well. And I'm going to say at this point, this is what usually happens when something fails that is a traditional asset class, is that they will come out and, you know, tell something that's true, moderately true, and then try to shift you to their product they're promoting, whether it's crypto or any other Finfluencer asset as well. So this is why I'm going to say, guys, one thing as well. Get the facts. Watch out for the Finfluencer BS, because a lot of them are going to be out there. They're going to recommend products. They're going to have little links that they get promotional materials for and anything like that, because the investment's probably not for you, and it's probably for them to get this gain of a big event happening. And it occurs quite a bit. You might be like, oh, you know, I can't believe they're doing it here. They've done it for multiple other areas as well, these reactors, okay? They've done it for Johnny Depp's and Amber Heard's trial. They reacted to it and made a lot of money off of it as well, and then put their fingers here as well. And this is what these sort of people do as well, okay? So with the SVB bank collapse, of course it's serious. Very, very serious. Could lead to contagion, could lead to other banks collapsing. But at the same time, you got to realize at the same time why they went bankrupt. Was it because they invested in bad investments? Not really. They were pretty safe. Was it a bad idea of their shift? Yeah, bad timing. Would they be held responsible? Unlikely, okay? Unlikely. Because they probably had some justification at the time of when they invested in it, and that will probably stand up. A lot of people are going to be like, oh, they should be jailed, hung, drawn, and quartered. But at that time in 2021, where basically, I think the RBA as well in Australia said interest rates weren't going to go up to 2024, it seemed like a good strategy. Now, seems like a poor strategy, obviously, since it backfired massively. Because, of course, they lost 10%. But just be aware at the same time, I think the government is stepping in, obviously. Obviously, the US government is stepping in. But a lot of people expecting these bank CEOs to be hung, drawn, and quartered. I don't see that happening, honestly. Really don't see that happening because A, corruption, and B, at the same time, if you want to go off the corruption route and give them benefit of the doubt, in 2021, it was a different financial landscape where no one was expecting rates to even go up until 2024. And you can just check the RBA for that one as well. And yeah, no one predicted these rate rises. So it's obviously not a blameless kind of, it could be a blameless kind of scenario here as well, because people were doing their best intentions in this as well. Anyways, guys, if you enjoyed the explanation, like, comment, subscribe. Just don't buy the Finfluencer BS. Just look to the facts. Look at the time period when they made that decision and keep shifting back and forth. And you'll see, you know, you'll be like, just understand the decision, basically. You understand their mind process and you understand why they made that decision. And that's what you need to do as a person with these big financial collapses and stuff like that. You can tell whether it was greed, which I could say in this one, I don't think is really greed for Silicon Valley. They were trying to look for a higher interest rate to serve their clients, basically, because they weren't getting any big bonds. They got punished on that, and that's what's occurred. That's pretty much it. And it leaves a big message to the other banks is that when you're doing your fixed interest assets, the safer assets, make sure you're managing duration risk, which is the interest rate exposure you have to your bonds. Because if you don't, and an event happens like this, you could just simply go bankrupt. Like, comment, subscribe, and hope you guys have a great day. Bye.